I have no idea what the price is going to do in the short term. I mean, I think I have a $250,000 end of year price target.
Is that still your price target?
I think we could double going into the end of the year. If Trump has anyone who needs to be approved on any of these advisory or boards, it better happen before then. And so my thesis will be more validated if obviously Jerome Powell will be off the chairmanship in May of 2026. How do the elections go with these board governors and the district banks? Can he get Cook fired by that point? And so once he gets all these pieces in place, then I think it's going to be crazy. Nuts time.
Okay.
Because then, obviously Besant's on board. Then you have the Fed. Now you have control of the banking regulations, so you can deregulate the banks. You have control of the mortgage market. So there's, I don't know the amount, but there's like something single digit or tens of trillions of dollars of home equity locked in American homes. And if you lower the rates, they're going to spend the money.
Arthur Hayes doesn't sugarcoat it. The world is drowning in fiat money. Governments keep creating more of it, and every time they do, the cash in your pocket quietly loses value. Your salary might look the same on paper, but it buys less each year. That's why, he says, people are turning toward assets that can't be inflated away, Bitcoin being the clearest example. Its supply is fixed, and that simple fact becomes more powerful every time central banks decide to print. Hayes warns that if the U.S. government starts chasing revitalization through cheap mortgages, lower interest rates, and more spending without raising taxes, it'll only mean one thing: more printed money. That path feeds inflation and widens the wealth gap. Workers earning wages get squeezed, while asset holders grow richer. The answer, he says, is to own appreciating assets. In the past that meant gold or stocks, but over the last decade, Bitcoin has outperformed them all. On the political front, Hayes notes that for Trump's economic playbook to actually kick in, his allies would need to take key roles at the Federal Reserve and Treasury before 2026. If that happens, expect a fresh surge of money and credit, especially through housing. But if Democrats regain control, that inflation-fueled expansion might stall before it starts. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
Our bags perform well when there's more fiat created. And we have a small asset. It's fixed supply asset, Bitcoin, and obviously there's other cryptos. Fixed supply asset, we have this gargantuan amount of fiat that has been created and will be created. The faster that goes, the more people run to Bitcoin and crypto. And so if everyone believes that, okay, Trump's got control, you listen to what Buffalo Bill Besant says on television and in the print, and he talks about how they want to revitalize America and they want mortgage rates to come down, and everybody gets a house, everybody gets a car, everybody's got a good and nice job, all these things, but no one pays any more taxes. So everybody's got this new amazing life that they didn't have to pay for because there's magic money coming out of the sky provided by the Federal Reserve and the U.S. Treasury. Then our job as investors is, okay, well, we know that if you earn a salary, you're fucked, right? You're just going to not make ends meet. So then what do we have to do? We have to find a way to get some sort of financial asset. And previously it was like gold and stocks, right? Before crypto. Now we have crypto, which has been the best performing asset class, Bitcoin, I'm talking about, in human history. When you talk about the amount of fiat that's been created since 2009. So, okay, I need to save some fiat. I need to buy some crypto. Hopefully it goes up as there's more fiat created. I know that my salary is not going to go up as fast as dollars, yen, euro, yuan are printed, and that's sort of the game at the end of the day of what we're trying to do. I have no idea what the price is going to do in the short term. I mean, I think I have a $250,000 end of year price target.
Is that still your price target?
I think we could double going into the end of the year. My concern is, okay, well, from a political standpoint, a lot of this depends on Senate confirmation in the United States. And if you look at Stephen Moran, which is the most recent board governor confirmed by the Senate, it was by one vote. So it's very, very tight for Team Red Republicans to get their people through.
Team Red.
And so I am operating under the assumption that Team Red loses to Team Blue in November 2026, both the Senate and the House possibly.
Yeah, Mamdani is certainly giving us
which means that if Trump has anyone who needs to be approved on any of these supervisory or boards, it better happen before then. And so my thesis will be more validated if obviously Jerome Powell will be off the chairmanship in May of 2026. How do the elections go with these board governors and the district banks? Can he get Cook fired by that point? And so once he gets all these pieces in place, then I think it's going to be crazy nuts time.
Okay.
Because then, obviously Besant's on board. Then you have the Fed. Now you have control of the banking regulations, so you can deregulate the banks.
Mm-hmm.
You have control of the mortgage market. So there's, I don't know the amount, but there's like something single digit or tens of trillions of dollars of home equity locked in American homes. And if you lower the rates, they're going to spend the money, especially if the federal government is underwriting these loans. So the housing market could be used to juice things even further. Again, you need control of certain agencies to be able to do this. I think by mid 2026, if we're going to get this money printing bonanza, Team Trump needs to have gotten all their people in place.
Yeah.
Because post then, I think it'd be very tough for them to, beat the Democrats just because people don't like him. Half the country hates Trump. And so what?
Right.
The thing's moving the other direction. Once you have a stable coin and now you've got a dollar bank account, if you're not an American, now you've got a dollar bank account. What do you do? Okay, well, I want to earn Fed funds, whatever it is, 3, 4, 5%, whatever it ends up being. Okay, I've done that. Okay, cool. All right, so more inflation. Got to do something else. All right, so what else can I do? Oh, there's this thing called Athena. It's an endogenous yield in crypto. It's usually about 2 to 3x, which you get in treasuries. Okay, cool. I can make it 10, 15%. All right, what's next? Oh, I want to go, buy coffee at 7-Eleven. Oh, we'll take your stable coin and we'll let you spend it offline and using EtherFi and other solutions. Okay, cool. All right, well, I'm still broke as fuck. I'm making 10% of my money. That's great. I'm making better than the bank. I'm not getting depreciated like I was in Argentinian peso or something like that. I've done well, but I need to make more money. Okay, I'm going to speculate. So now I'm going to go to Hyperliquid or whoever the dominant DEX is at the time, and I'm going to trade, I don't know, Dog with Hat, Pepe Coin, Bitcoin, whatever the fuck I want to trade. I'm going to speculate on everything with high leverage because it's the only way that I can escape this drudgery that is working for a fixed salary that doesn't increase as fast as the amount of money that's being printed. And so I think that's what, it's a very sad situation that the world is in, but this is where anyone who doesn't have financial assets finds themselves is, okay, the only way out is to speculate. And now I have this new way of speculating that's outside of the stock market, which, is intrinsically rigged against me. You might say crypto's rigged against you as well, but I say that there's more opportunity to trade whatever you want, however you want in the crypto space versus in the domestic stock markets around the world. And so now people can say, okay, I've got these stable coins. I literally just connect my wallet and now I have this whole, ecosystem in front of me where I can trade these things. I can lend these things. I can borrow against these things. I can do all these different things and hopefully outpace this inflation that's being generated by the powers that be.
Arthur Hayes breaks down how the Federal Reserve's money creation really works and why it often fails to boost the real economy. When the Fed injects liquidity, most of it goes to large banks and financial institutions. That money circulates among corporations, hedge funds, and private equity firms that already have easy access to credit. They use it to buy back shares, refinance debt, or acquire assets, not to build new businesses or hire workers. The result is rising stock prices but stagnant economic growth. The so-called money multiplier, which measures how far new money spreads through the economy, barely moves. Hayes says the real shift happens when credit starts flowing through regional and community banks to smaller firms, factories, startups, and local industries. Those loans fund production, jobs, and innovation. As workers earn and spend, that money cycles through the economy, fueling genuine growth and inflation. Hayes calls this QE for the poor, because instead of inflating asset prices, it strengthens income and demand from the bottom up. From the government's perspective, this setup is ideal. If economic growth outpaces the rise in debt, the debt-to-GDP ratio improves, just like it did during the stimulus-heavy years of 2020 to 2022. Let's get back to the interview.
So with the Fed, money moves basically through the large money center banks to financial players or large corporates, right, who have access to institutional corporate debt markets or a private equity firm who has the ability to borrow to lever up an existing cash flow stream. So no new cash flow streams are created. I just have access to credit from the Fed and the banking system, and therefore I'm going to lever up an existing cash flow stream. So no one new gets hired, no new economic growth, nothing like that. So the money multiplier is very, very low. The average person doesn't receive any credit. But in this situation, I call it QE for poor people, when the regional bank is lending to a SME or an industrial firm, right? They're creating this new loan, creates a new business. They're going to build a new factory or start a new product line. They need to hire more workers. Those workers get paid. Those payments go into the banking system. And so the money multiplier is ultimately higher. Nominal GDP grows faster, and obviously inflation grows along with it. And so you get a faster expansion in the money supply, you get a faster expansion in economic growth, and you get a faster acceleration of inflation, and that's what drives assets higher. And so, but from the government perspective, their debt to GDP declines,
right,
which is what it did from 2020 to 2022 when Trump and Biden did this policy for a little bit. If you are a person who's going to benefit financially, asset-wise, in this scenario, this is great for you, this situation. If you are someone whose salary is not going to keep up with the inflation that's generated by running the economy hot, then this is a terrible situation for you. So I guess it's depends on who you are, what kind of assets that you have. But in general, if you take a look at China and some of the North Asian countries who've run a similar sort of policy, the real after savings earnings of the savers who put their money in the domestic banking system vastly underperform the growth in the economy. And so, that's why you have the central banks with trillions of dollars of quote unquote savings. That's the wealth of the people that they didn't allow them to spend. And so depends on where you fall on this sort of the common good versus the individual and all those sort of philosophical points of whether you think this is a good thing or a bad thing. If you look at Germany and France, essentially were political creations of the United States after World War II, who have grown extremely wealthy by being able to export their goods that were financed by America initially, not anymore, back to the American market, but American firms cannot sell their goods essentially in those markets. And so obviously this system creates a lot of gross inequality on both sides, and that's gonna, it's gonna change. And only it's just gonna go back the other way.
Yeah.
So it's inevitable that the thing that made America great, which was everyone blew themselves up, and America had 50% of all manufacturing capacity and everyone wanted to own dollars back in the 1950s and 60s. That can't last forever if you've built up the rest of the world, and so now things have to reverse. So it just is math. When you have $35 trillion or whatever, $20 trillion of marketable debt, and you're not growing as fast as your interest payments, then mathematically you cannot escape that. I don't care how many stable coins you have. Like, great, de-dollarization was slowed. But, if I'm Saudi Arabia or China or Japan or Germany on a net basis, I don't really want to own a treasury. I want to own gold, or I want to invest back in my own country because I have to be accountable for my people for this change in the architecture of trade. Cool. It's great that you got a bunch of poor people around the world to have a dollar, and maybe that's a few trillion more, and they buy some T-bills. But they got to refinance it every 3 to 12 months. Like, it's not the end state that you want to be in. And especially if your debt load is growing faster than your economy, like exponential math. We know the math. We know that the debt load will go faster. And what did people do in history? Either they do some sort of debt jubilee. So the American political class could say, okay, we're just going to cancel all the debts. We're not going to pay back the foreigners, but we're not going to pay back people and asset holders as well.
Okay.
There's costs and benefits to doing that. Or we're going to inflate away the debt, right? Run QE for poor people and get the debt to GDP down. That's what they did after World War II. That's also an option. So there's different paths, but at the end of the day, you don't want to own bonds. And if you have the ability, you want to be selling dollars and owning a hard asset like Bitcoin or gold.
What's unfolding now isn't just another economic cycle. It's the slow erosion of trust in the very idea of money. Every new round of stimulus, every promise to boost growth through credit, chips away at purchasing power while concentrating wealth at the top. The illusion of prosperity stays alive on paper, but everyday people feel it fade in real life. At the grocery store, at the gas pump, in their paychecks that don't stretch as far as they used to. Meanwhile, those holding scarce assets, real estate, metals, Bitcoin, watch their value multiply, not because the assets changed, but because the currency measuring them keeps weakening. The next phase of this story will hinge on who controls the levers of money creation. If policy turns toward more printing under the banner of economic revival, the gap between financial security and dependency could widen even faster. Yet, if credit begins reaching small businesses and local economies instead of financial giants, growth might finally start to feel real again. Either way, the financial landscape is shifting from speculation to survival, and the winners will be those who understand that fiat-based wealth isn't built to last. As the tide of easy money keeps rising, one has to wonder, how much longer can a system built on expanding debt sustain confidence before people stop believing in it altogether? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.